All right. Can everybody hear me well? Can you hear me, Doug?
Yes.
Okay, great. Good morning, everyone. First of all, thank you, Doug, for the introduction. I just wanted to add a few things here. Like Doug mentioned, I am federal benefits consultant. I educate federal employees across all agencies about their benefits and retirement. And my mission here is to help you understand what is available to you as a federal employee, how to get full use of it, and what happens to your benefits after you retire. And like Doug already said, I've been doing this for about past 6 years. In this session today, we'll do a quick general sort of high-level overview of your 7 main benefits. I call them 7 superheroes, and let's jump right in. Today, I will be talking mainly about FERS retirement system. I will not be covering CSRS, or some people call it CSRS system, simply because there are not that many people left in federal workforce who are under the old system. FERS system was put in place in 1988. So that means if you were hired in or after 1988, you are under FERS. I call federal retirement system a 3-tiered pyramid or 3-legged chair. First leg of your retirement system is basic benefit or FERS pension. Some people call it an annuity, but I like to call it pension. FERS pension is a guaranteed income for the rest of your life and even possibly for the rest of your spouse's life. And by far, it is the best benefit that you have. Private sector companies, as we all know, almost never offer pensions anymore. And this benefit is probably the main reason why federal employees stick with federal government for the rest of their careers. There are 2 other income sources available to you when you retire, and it is Social Security and Thrift Savings Plan. There are a few ways you can retire from federal government. In this session today, we'll be referring to the first option on this list, and it is voluntary, regular, immediate retirement. The word immediate here means your pension begins immediately. Most federal employees retire under that first option. But just so you know, there's also postponed retirement, early optional retirement, disability retirement, and deferred retirement. If you want to retire under regular immediate retirement, you need to meet 2 rules: age and years of service. And both of these rules need to be met in order for you to retire with full benefits without paying any penalties or leaving some benefits on the table. So you can look at this table. You can retire as early as 62 years young, but you need to have 5 years of service. In other words, if you're 62, but you've been with federal government for only 4 years, you can't retire without
I don't
paying
hear
anything.
anything.
Oh, excuse me?
Could everybody
Can you hear
please mute? Everybody please mute your computer. There's somebody, we have background noise.
Can you hear me now? Doug, can you hear me?
Yeah, I can hear you.
Okay. Can everybody hear me? All right, I assume everybody can hear me.
Somebody needs to mute. Thank you.
Doug, maybe you can, I believe you should be able to mute everybody from your
It
end.
sounds like they went off. They went off.
I just removed the person from the meeting. I hope I didn't offend anybody, but I didn't want to interrupt. You know, the group is more important than the individual here.
Sorry about that, guys, but yeah, let's get back to it. So second threshold for you is here. You can retire as early as 60 years old, but you need to have 20 years of service. And the third threshold is if you have 30 years of service, you can retire at the minimum retirement age. And here, this table shows you what that minimum retirement age is if you have 30 years of service. And that age depends on the year you were born and that's anywhere between 55 and 57 years old. Most people probably will fall into that 57 years category. In other words, if you're 57 and if you have full 30 years of service, you can go ahead and retire with full benefits. It is very easy to calculate your pension. The formula is super simple. It is top high 3 for your salary multiplied by years of service multiplied by 1% if you're retiring under age of 62. And if you retire at age 62 or older, it is top high 3 multiplied by years of service multiplied by 1.1%. They call age 62 is magic age for vets to retire. And this is because you get extra 10% increase crediting in your pension calculation for the rest of your life. And basically the difference here between 1% and 1.1% is 10%. But of course, if you work past 62, your pension will be even bigger because you'll have more years of service. There's no limit or cap on your pension here, meaning if you decide to work for 40 or even 50 years for federal government, you'll get credit for all those years. Top high 3 is the average of your highest salary during the consecutive 3 years or consecutive 36 months. And for most people, it will be the last 36 months of their career. Only base pay and locality pay counts towards top high 3. Overtime and cash awards don't count, unfortunately. And there's good news here. All first pensions have cost of living adjustment, meaning you will see about 1 to 3% increase every year in your pension payout. That's to adjust for inflation. But of course, past couple years that COLA was bigger than that because the inflation was so big. But on average, it is 1 to 3% bump you're gonna get on your pension. Let's take a look at the example here. So let's assume this individual, this federal employee, has a top high 3 of 100,000. He has 30 years of service and he's 57 years old. So here's how we do the math. 100,000 multiplied by 30 multiplied by 1%, and he will receive $30,000 as annual gross pension. And to come up with a monthly figure, you just simply divide that by 12, and that's $2,500 he will receive or she will receive of monthly gross pension. That is very important to underline here. It's a gross figure. It's not including any taxes or deductions. And what's coming out of your pension check is federal and state taxes and probably your health insurance or any other optional benefits that you may keep into retirement. Okay, let's move on here. One of the most important decisions you need to make when filing for retirement is which pension option to choose. And there are 3 choices available to you here. First one is single life. That's when you get that maximum payout from the previous example. That's, let's assume, $2,500. So you'll receive $2,500 a month for the rest of your life, but plus that cost of living adjustment. But if you pass first, and if you are married, your spouse will not receive anything. There's a second option available to you, 50% survivor. And that means if you pass first, your spouse will receive half of your pension, half of that $2,500 for the rest of their life. But this option comes at a cost. It will cost you 10%. Your pension will be reduced by 10% in order for you to provide that survivor option to your spouse. There's also a third option, 25% survivor, and that means your spouse will receive quarter of your pension and it will cost you 5%. You may be wondering which option is best. Well, it depends. Survivor options are very expensive because your pension will be reduced, like I mentioned, for the rest of your life by 10 or 5%. And over the period of 25, 30 years, that could be a lot of money. So is the survivor option worth it? To help you decide, you need to answer a few questions. First one, what is the age difference between you and your spouse? If your spouse is 10, 15 years younger, then probably 50% survivors, that maximum survivor option is a good idea. Another thing to consider, what is your health of you and your spouse? Longevity here plays a big role when deciding what option to go with. You make this decision when filing for retirement. Your spouse needs to sign that page in your retirement packet, and their signature needs to be notarized. And that once you file for retirement, that decision is irreversible. There's one very important detail that you and your spouse need to be aware when deciding which option to go with. If you pick single life or that maximum payout pension and you pass first, your spouse will not be able to stay on federal health insurance. And the reason behind it is kind of silly. Federal government is saying we don't want to accept premiums from outside. We want to deduct premium from a federal paycheck. In other words, if your spouse is not receiving federal paycheck, they're not going to be able to stay on federal health insurance. They may change it in the future, but it is what it is as of right now. So you and your spouse need to be aware of this little detail. Actually, big detail, I should say. Another great benefit that you may be eligible for is FERS supplement. Some people refer to it as Social Security supplement or Social Security bridge. This benefit actually doesn't have to do anything with Social Security. It is a benefit completely funded by federal government and not by Social Security. Purpose of this benefit is to help federal employees to retire before they're eligible for Social Security. And the earliest age you can collect Social Security is 62 years old. So if you retire anytime between 57 and 62, you will receive supplement until you reach 62 years old. Supplement is designed to provide percentage of your Social Security, and it comes automatically with your pension check, and it will automatically stop when you reach 62 years old. And once again, 62, that's the minimum age you can start collecting Social Security. And I just wanted to bring it up here. We will not be discussing Social Security today or Medicare because it is such a big subject. If there is a demand for it, I may do a separate presentation in the future just to go over Social Security and Medicare. One little detail you need to be aware here. Some retirees like to get a part-time job in retirement. And if you plan on doing that and you are receiving supplement, there is an income limit. And that limit is about $21,400 a year. And if you make more than that, you may lose your supplement. And here's the formula. You can see the formula how you to calculate the supplement. And it is years of service multiplied by your Social Security benefit that you would receive at 62 divided by 40. And then I just pick an example here, 30 years of service multiplied by 2,000 divided by 40, I'm sorry. And that's about $1,500 a month of supplement this individual will receive based on 30 years of service. Health insurance is another super valuable benefit that you guys have. You only pay about a quarter of the cost. There are 3 enrollment options available to you: self plus one, and family plan. Children can stay on your plan until 26 years old. Once your children age out, you need to switch to self or self plus one. Otherwise, you will be charged for family plan for the rest of your life or until you go in and make that switch. Change in family status is qualifying event. That means you don't need to wait for open enrollment season to make that switch. And it is a very, very common mistake that federal employees make, they forget to switch their health insurance to Self or Self Plus One when their children age out. And if you think this may be you, I can help you fix that and possibly even get a refund. There's one little trick here, which this, and here's another thing that doesn't make sense, but some family plans are cheaper than Self Plus One. So before you make that switch, you want to make sure you'll be saving money and not paying more.
I got out of that, boy.
Oh, good.
Like
And
damn
you
Steve
can
Barron.
keep
You're fucked up, man.
Or a yellow mark.
You ever tried before?
You can keep your federal health insurance for the rest of your life, and your costs will remain about the same. You will continue to pay about a quarter of that cost, and federal government will continue paying about 75% of their share. But of course, your health insurance price will go up every year about 5%, but that's not because you're retired, not because you're getting older. It's because health insurance costs are going up across the nation for everybody, regardless of your age. Now we will discuss life insurance. There are two main components of your federal group life insurance, the abbreviation for it, FEGLI. Basic life insurance and optional. All federal employees automatically get enrolled into basic. And basic is one-time yearly salary plus $2,000. There's also optional insurance available to you for purchase, and it's option A, option B, and option C. Option A is just flat $10,000. Option B, you can elect up to 5 multiples of your salary. And option C is family coverage. Basic FEGLI is pretty good deal because you only pay about 15% while working. Optional insurance, on the other hand, will get pretty pricey if you keep it long enough. When you're still young, option B seems cheap, but what often federal employees are not aware of is that the cost of option B nearly doubles every 5 years because it is a 5-year term life insurance. To give you an example, $300,000 option B life insurance will cost you only about $20 per month between age of 35 to 39. When you reach 65, the cost of that life insurance goes to $312 a month. And by the time you are 70, you will be paying $550 a month for that life insurance. Another biggest mistake federal employees make is keeping option B life insurance for too long. And the solution is, of course, if life insurance is important to you, get life insurance on the outside. It will almost always be cheaper in the long term. What do you do with your federal life insurance is another important decision you need to make when retiring. Basic FEGLI is no longer that cheap when you retire. It can get expensive as well if you decide to keep your entire basic into retirement. But the good news, you can keep 25% of your basic for free for the rest of your life. So, question is, should you keep full basic or not? It depends. First of all, have you gotten life insurance on the outside early in life? If you did, then certainly that life insurance will be cheaper than keeping that full basic. Most likely it will be cheaper. Second one, do you even need life insurance? Maybe your kids are grown and they doing way better than you financially. And if that's the case, then just keep the 25% of your basic for free. A third important detail to consider, what is your health? If someone is not expected to live too long and they want to leave legacy behind, then of course you should keep your full basic, and maybe even you should keep that option B times 5 if that's what you have into retirement as well. But once again, if life insurance is important to you in the long term, get a policy on the outside, preferably as young as you can. And reach out to me. If life insurance is important to you, you can always reach out to me. I'll show you what's available to you. There are some great policies out there that are offered exclusively to federal employees. Now we will discuss long-term care insurance. What is long-term care insurance? To put it more simple, that's the insurance that pays for nursing home. Medical science advancing every day, therefore people live longer. If we live past 85 or so, which becomes norm nowadays, there's a very high chance we will require some sort of long-term care. Nursing homes are getting built left and right, and demand is only rising because, like I mentioned, people live longer. Average cost of nursing home facility is about $120,000 a year for a private room and about $100,000 a year a shared room. Long-term care insurance will help you reduce that cost. Typically, it will not cover the entire cost, but it may help significantly. And this, of course, a voluntary benefit available to you through your workforce, through federal government, and also private insurance companies offer long-term care policies as well. There is a biggest misconception: who pays for long-term care? Some people think that Medicare or health insurance will pay. It does not. Medicare or health insurance or TRICARE do not pay for long-term care. And who does? Who pays for long-term care? Like I mentioned, federal long-term care policy will pay for portion of your long-term care needs if you've gotten one. Private long-term care, private insurance companies do offer long-term care policies as well. Medicaid. Now, Medicaid will pay for your nursing home needs, but there is a very, very strict income and assets restrictions. Basically, you're allowed to have about $1,000 to your name, and if you have more than that, they will take it all. They will take your home, they'll take all your assets to pay for long-term care before they pay anything. And there's a 5-year look back. They look into your finances for the past 5 years just to make sure you didn't gift everything to your kids or other family members in order to avoid that long-term care cost. You can pay for your long-term care yourself if you have enough savings. Sometimes the burden goes on your kids, unfortunately. And if you're a veteran, you are covered here. VA has its own long-term care facilities for veterans. And if you're a veteran, you can go to this website I listed here, veteranaid.org, and look at what your options are. TSP now. TSP is your second best benefit next to your pension. It can potentially be your biggest source of income when you retire if you do it right. Mistake number one that federal employees make is not contributing enough or not contributing at all to your TSP. Anyone I meet with, my first recommendation is to max out their TSP contribution. It is by far the best retirement savings investment tool. TSP is one of the best ways for federal employees basically to become millionaires. And there is a 5% match, meaning if you put at least 5%, you get extra 5% on top of it for free. But of course, the more, the better. The more you can put into that account, the better you will be off when you retire. And the maximum contribution is $22,500 per year. But if you're 50 or older, you can add additional $7,500 per year. And it is very, very easy to increase or decrease your contributions, and it's in MyPay. So let's say if you decide to max out your TSP, but then you just don't have enough money to live on, you, of course, don't get into credit card debt just because you want to max out your TSP. You can go into MyPay and reduce it at any time. Like I mentioned, it is an investment account which have investment choices. There's 5 main funds available to you, plus the life cycle funds. G-Fund. G-Fund is like a CD. It's basically cash. Cash is the safest, as we all know. It's guaranteed not to lose, but it doesn't make much money. It doesn't grow much. Next one is F-Fund. F-Fund is government bonds. You're basically borrowing money to federal government and they pay you back with interest. But be aware here, bonds may lose value. And the next three funds, CS and I, those are stock funds. What are life cycle funds? Life cycle funds is the mix of all the funds above, and that's the appropriate mix for your age. And 2020, and you can pick anywhere from 2025 to 2060 fund. And that number, that's the closest year of your retirement. What I like about the ELF funds is that they move you a little bit more conservatively every year as you get closer to retirement. So if you're in a 2060 fund today, it's going to be mostly stocks today. But in 2060, it's going to be mostly G and F fund, the safer funds. And the idea behind it is to reduce risk as you get closer to retirement, because as we all know, stock market can go down 40% in 1 year. So ELF fund kind of protects you from that, for having too much risk as you get closer to retirement. For the longest period of time, G fund was a default fund. So if you never made any changes, and some federal employees never went in and made that change, made that switch, they stayed in G fund for their entire working life, and so almost no growth. Luckily, government fixed that mistake. Well, it only took them about 30 years to do that. But if you started in 2018 or later, the default fund is now appropriate ELF fund. There are two types of TSP accounts available to you: regular and Roth. The main difference here is when you pay taxes on the contributions. With a traditional, when you contribute to traditional TSP account, you don't pay any taxes on the contributions today, but when you retire and start taking money out, that's when you pay taxes. Roth is complete opposite. Money goes in after tax, but when you retire and start taking money out, you no longer need to pay taxes. Which one is better? It's really hard to tell, but the idea here, if you think your taxes will be higher in the future when you retire, you're better off paying taxes up front today, and that's Roth. If it's the other way around, then you're better off with the traditional. But to be honest, Roth is not some sort of magical tax-free account, as like people think a lot of times I hear. That's a misconception about the Roth. You still do pay taxes. It's just you pay your taxes up front. But to be honest, the best thing you can do is just to put as much as you can into your TSP, regardless if it's Roth or not. You can split your money. You can do a little bit of both. In the end, it's going to all even out. All right, so now let's assume you are retired or about to retire and wondering what to do with that $1 million or $2 million in your TSP. Should I buy a house, a boat, or pass it on to my kids? First, do you guys remember what is the true purpose of this account? It is a third leg of your retirement, and the purpose of it is to supplement your retirement income in addition to your pension and Social Security. It's a third layer of that pyramid that I showed you in the beginning. But the good news is you can do whatever you want with that money because it is your money. Before you do anything, you need to be aware of implications. First, anything you take out of your traditional TSP is fully taxable as ordinary income. That means if you take out too much in one single year, you can increase your tax bracket. And here's a real life example. I met with this federal employee. He was still employed, he was still working, and he took out $400,000 out of his TSP account and bought a house with it. Huge mistake, because IRS looks at it as he made $400,000 in addition to his $150,000 salary. His total income for the year was $550,000, and his tax bracket jumped to the highest in the country from 22 to 37%, and he paid highest possible tax on that withdrawal. And the idea here, you want to reduce your tax consequences, not to maximize it. If you decide not to touch that money, maybe Social Security and pension is enough. That's fine. But when you reach 72 years old, you have to start taking money out of your retirement account. That is an IRS rule. And they made that rule so they can start collecting tax on that money. And it is called RMD, or required minimum distribution. And if you forget to take that RMD, IRS has the highest penalty possible, and it is 50%. You'll have to pay 50% penalty on the amount that you should have taken out. There's also 59.5 year rule. That means if you touch your TSP money before you reach 59.5 years old, you will pay 10% penalty on top of any taxes that you may owe on that money. If your children are your TSP, they will be responsible for paying taxes on that money if it's a traditional TSP. The ultimate strategy here is to take out little by little to supplement your retirement income. That strategy will help you minimize your taxes and make sure that money will last you a long time and hopefully a lifetime. And turning your TSP into guaranteed income for life is a very popular option for federal employees as well, and it is called lifetime income annuity. All right. The last thing I will talk about today is, how do you make the decision to retire or keep working? There are a few quite important things you need to think about before you retire. First one, do you really want to retire? Or you absolutely love your job and your job is what makes you happy? There is a category of people who just never even imagine themselves ever being retired. Next important question is, what are you going to do in your retirement? What are you going to do with your free time? You don't want to fall into depression just because you are retired without a plan. Are you going to watch TV, read books, travel, babysit your grandkids, maybe get a part-time job or start a business? Volunteering is another popular one. Basically, you need to plan what are you going to do with your free time. Financial aspect is also super important. Can you afford to retire? What is your budget? How much money do you need on a monthly or yearly basis? For some people, their expenses go down in the retirement. For some people, they go up. Travel, for example, can get expensive. General rule in financial world is you want to have at least 80% of your current income into retirement for you to be able to retire comfortably. And of course, health is super important factor to consider as well here. You want to be healthy enough if you decide to keep working, but at the same time, you also want to be healthy and full of energy to enjoy your retirement. You don't want to push yourself too hard to work too long where you can't even enjoy your retirement no longer. So before you file for retirement, go get your physical done, because a lot of your decisions may be affected by the condition of your health. And my last recommendation to you all, request your federal benefits analysis done. It will help you answer a lot of questions. So that was a quick high-level overview of your core main benefits. If you need my further help with benefits that are specific to you, you can email me your request. I provided here my email address. You can also go to our website and submit that request directly through the website. Your personalized federal benefits analysis will be specific to your particular situation, and it is a free service that's available to all federal employees. So please do take advantage of it. Benefit analysis will show you what benefits you have today and what they will be when you retire. It will also show you if you are on track for a comfortable retirement one day. And if you are not, I can potentially provide you with recommendations on what you could be doing differently to change your retirement outcome. And I also put my phone number on here. That's my direct line. So if you need to reach me over the phone, you can just give me a call as well. That's all I have today. Like I said, we did not discuss quite a few other topics such as Social Security and Medicare, but maybe we'll do it in the future. Thank you so much for your attention, and I'll pass it on to Doug now.
Great. Thank you, Victoria. That was informative, and I learned a lot because I've had some of these and I don't, you showed a complete overview of the main things, the TSP and the FERS and insurance. And we appreciate that. We'd love to have you back. I think people are going to want to know about some of the specifics, and we appreciate that. So also, just to let the members know, next door, we're bargaining the return to the office. For some of you who weren't able to participate yesterday or come to our presentation, the union's position is that Secretary McDonough proposed 50%. The union, our proposal is 30%. So each pay period, 1 week, 2 days in the office, the other day, 1 day in the office. That basically sums up our position with a few other things. And one other thing, we're having a holiday party coming up in December. I'll announce that. That's for members. This email I sent out with the invitation went to everybody in the bargaining unit, which includes dues-paying members and non-members. And if you want to go to the holiday party, you can join before or you can join at the event. So thanks, everybody. We appreciate your support and participation. And if you have any other topics you want to know more, send me an email and we will have a lunch and learn presentation. So appreciate it. Thanks again, Victoria.
Thank you, everyone.
Bye-bye.
Bye-bye.